quality breeds quality, right? You know, if you're in a great area with good socioeconomic demographics, and that's going to draw in more good people, and vice versa.
G'day guys, welcome to the Pumped on Property show with Simon and myself, Ben Everingham, over at Pumped on Property. Pretty excited about today's podcast. Had an epic little start to the day and a good morning.
Yeah, no doubt about it. You know, we've done a few podcasts recently on, you know, how to learn a little bit more about property investing. And today we're going to dive a little bit deeper into the nitty gritty, which is essentially talking about how to select the right suburb to invest in.
So in terms of the right suburb, it's taken me a long time to identify what are the big rocks, what are the most important things that you can focus on that make the most difference without stressing yourself out and looking Australia-wide like I used to. And we're going to get into all of that detail. We're also going to share some examples of real suburbs in Australia right now where there's a massive value gap between this suburb 10Ks from this city and this suburb 12Ks from the city, so that maybe you can take advantage of that, and then share some of the stories that we've got in our personal portfolios of going for better quality suburbs versus cheaper ones and what that's created in terms of wealth, rental income, and overall position for both of us as well.
Now, all we're really trying to do is get the best return on our investment over the long term. Like, that's ideally what we want to do. And, you know, the way that we look at it is compound growth. So you play with some compound growth calculators online, and you can get a bit of an understanding where, you know, you're spending the same amount of money over the same amount of time, but you're just trying to get a better gain over that longer period. And these are the little things which we don't know how much of an impact that they're going to have, but from some of these examples that we're going to break down, have had a huge impact in the past.
So many of the clients that we work with are like, man, I had no idea how much detail you guys go into and how OCD you guys are on buying. And a lot of clients are like, you know, we really want to buy like today. And I'm like, well, it might take us a month to find the right place. And it's because I understand this compound growth thing, and I understand, you know, the 100 pieces of information that you need to get right to knock it out of the park. Now, let's look at the compound growth thing for a sec, because this is why selecting the right suburb is so important. So let's say that you've got $1 million to invest in your own home or a couple of investment properties, and you go and spend that $1 million, and over the next 15 years, you get 4% compounded per annum over that period of time. Now that gets you to a figure which I don't have in my head right now, but if you were to go and put that exact same money in a bit more of a thoughtful place, getting the suburb right, and the street right, and the house right, which we'll talk about more in the next podcast, then that difference in just 2% per year, getting 6% compounded versus 4%, will end up making you about an extra $550,000 on $1 million over the next 15 years. Now, that is why I take this stuff so seriously. When I first started, I was always looking for the quick win, the easy money, the short, you know, uplift or buying below market value. Now I'm looking for the long-term capital growth, compounded effect of buying better stuff, because I only have a small amount of money. I'm not rolling in it. I'm just exactly the same as you guys are, which is investing in one good quality asset every now and then when I can afford to. And because I've got young kids, I put pressure on myself to nail that outcome and get the right result.
I couldn't agree more, honestly. And, you know, we talk to so many people that are like, I want to buy today. I want to buy right now. And it's like, okay, cool. Let's take a breath. Let's slow this down, because what's more important to us is trying to get that extra $500,000 over the next 15 years, not trying to save ourselves $5,000 or $10,000 on the way in. So our minds are always looking into the future and looking at the big picture. The short-term stuff doesn't matter to us. Property to us is a marathon, not a sprint. It's so valuable to develop the right strategy, identify the right market, identify the right suburbs, take our time finding the right property within those suburbs to ensure that we're mitigating a few of those risks and hopefully putting ourselves in a position where we're going to be in a far better off financial situation in the future.
Now, some of these gold nuggets, if you're serious about property investing, then this is the way you interpret a suburb. I wish I had these 10 years ago when I was just getting started.
Grab your pen and paper.
I was looking at all the wrong shit. I thought realestate.com and the blogs and the forums and the
10-year growth
videos meant something. It means absolutely nothing. What matters is these few key performance indicators. And if you can learn to compare one apple, which is one suburb in Sydney versus another suburb in Perth, accurately against these indicators. You know, for me, I can look at any suburb in Australia and within, honestly, 10 seconds know if I'm going to buy there or not based on these indicators alone.
Yeah, it took a while to get there though.
Yeah, I mean, you know, that's the effect of doing the same thing every single day for 10 years.
Yeah, so the first one is essentially distance from the CBD or the water. Now, water could be a bay, it could be a beach, it could be a river. But distance from the CBD or the water.
Now, Michael Matusik did some data crunching on this, which I love.
Absolutely.
What he looked at was places within Brisbane that were within 0 to 5 Ks of the CBD, 5 to 20 Ks and further than 20 Ks away. And what I found from his data, and he did this for Sydney, Melbourne, Perth, is that places closest to the city within that 20K range generally outperform places further away. Now, there's countless examples. Some of the most expensive suburbs in Sydney and Melbourne are actually a lot further than, the CBD away from that. So that's why Simon's point is important. Water can make a massive difference, and brand name or reputation or size of land can make a massive, massive difference as well.
Yeah, we haven't got like an article like Michael Matusik that's looked at the water thing yet, but I can't wait for it to come out because I'm sure it will soon enough.
I have seen him talk about the difference in prices between a place in the same suburb over 10 years with water views with and without, and the place with water views generally performs by about 90% better. But that's just a very small snippet of like the same suburb water view versus a non-water view in Brisbane.
So, relaying this to your property investment goals is really important because we can only service a certain amount. We might not all have the capacity to buy a $3 or $4 million home within 5Ks from the Sydney CBD or on the harbour. Same in those really high quality locations in Melbourne or $1 million in Brisbane. So, and that might not be what you're looking for. So you've got to factor in how much you can actually borrow and what you're really trying to get out of that investment. But just keeping that in the back of your mind that distance to the CBD does have a big impact and distance to the water does also.
Now, there's another cool indicator that we like to follow called the DSR score. That's the demand to supply ratio score. It's a great little gold nugget for a suburb. If you're just like comparing one suburb versus another, you can Google DSR score plus the suburb name you're looking at, and you should be able to find it for free. I like to personally buy when the DSR score is between about 55 and 75 out of 100, which is more of a buyer's market. If it's below 55, it's generally there's no demand in the area at that time, and the potential for short and medium term growth is generally very low. If it's over 75%, it's normally a seller's market where prices are rising extremely quickly, and that's more like an auction clearance rate of 80+% where people are going a bit feral, starting to pay a bit more, and that's driving the market up from the bottom.
Which once again, if it is over 75, it doesn't mean that it's a bad time to buy. You've got to factor in timing there as well, but just a really clear indicator to understand, where that market's sitting and what could be happening there at the moment. And helps us figure out how we should be negotiating as well.
I'm so glad that you mentioned that, because timing, you've got to understand where the area and the city or the regional market that you're buying is at in the global context and national context. A few podcasts ago, we did one on timing, which is definitely worth listening to. But let's say the DSR score in a suburb in Perth right now is 75%, and then a DSR score in Hobart is also 75%. Now, if you look at Perth in the last 10 years, it's actually 20% cheaper almost, according to CoreLogic, to buy Perth now than it was 10 years ago. But you look at Adelaide through the same lens and you go, Hobart has gone up by 70% in the last 10 years. So I go, both of them have relatively high DSR scores, which, should help with short to medium term gains. But I'm going to be putting my egg in the Perth basket because it has got so much more potential off the low base that it's coming off. And these are the things I think about. And this is why for the last 5 years, we've been massive advocates of Brisbane and Perth versus your Sydneys and Melbournes, because they're already coming off such a strong run up. I don't want to be buying someone else's profit when I can buy at the very bottom of a new cycle.
Yeah, so Ben and I will look at the 50-year performance, the 20-year performance, and the 10-year performance to understand how a market actually performs over the longer term. And if you look at that in Australia, Sydney, Melbourne, Brisbane and Perth have done killer over the last 20 and 50 years. Then if you look over the last 10 years, Sydney and Melbourne have gone gangbusters where Brisbane and Perth have done nothing. So timing, really, really important. The next one that we want to talk about, which is so important for investors, is vacancy rates. The vacancy rates is essentially the number of vacant rental properties in the market. So the higher the vacancy rate, the more rental properties that are on the market. The lower the vacancy rate, the lower amount of rental properties that are on the market.
You explain shit so much better than me, man. I was just sitting here and I'm like, I would have just gone straight into it. And I'm like, I love how my wife always says it to me. She's like, you've got no idea how to explain anything to anyone.
That's why I do the first strategy
why do
sessions
people
and you
even
do the second.
Yeah, she's like, why do people even like follow your stuff online? But you know, all jokes aside, I like to buy it when the vacancy rate's below 2%. When it's below 2%, it's an undersupplied market, which means you're going to find a tenant sooner rather than later. There's suburbs in Melbourne, for example, right now that have a vacancy rate of less than half of 1%. There's other suburbs that have a vacancy rate over 20% right now. So very, very important when selecting the right suburb. Just because a suburb has potential for growth and all of these other indicators look good, doesn't mean it's a good place to buy for rental. And that's a really key number to be able to quickly look at and go, cool, it's below 2%, looks good. Or hey, it's above 3%. Maybe I'll check out an area or find out more about why it's so high at the moment.
Exactly. And these can fluctuate depending on the market. You know, if you're looking further from the city in these new suburbs where these new developments are popping up all the time, you know, sometimes you're going to see a spike in the vacancy rates. Or, you know, if you're in an area where there's a massive new unit complex or a townhouse project that's just come to the market, it can skew them. So, you know, always want to look into it a little bit, but for us, rule of thumb, less than 2% generally means that you shouldn't have too many issues finding a quality tenant.
One of the indicators that is outside of this suburb stuff that I just find fascinating is when I overlaid the vacancy rates for like the capital cities of Australia versus the capital gains. When the vacancy rates, which in Adelaide, Perth, and parts of Brisbane are now below 1%. When the vacancy rates hold at less than 1% for a prolonged period of time, like 6 months or a year, it's saying that there's a chronic undersupply. People get the shits with renting, especially when money's cheap and they start buying properties. And then we see like generally quite strong capital growth off the back of an extended period of a low vacancy rate. So again, timing wise, you can use all of these little pieces to your advantage.
Now, the next few things that we want to talk about is how we like to identify those slightly higher quality suburbs compared to maybe neighboring suburbs. And, you know, this is what could impact that 0.5%, 1% or 2% in compounded capital growth over the longer term, because quality breeds quality, right? You know, if you're in a great area with good socioeconomic demographics, and that's going to draw in more good people, and vice versa also. So the first one is the average household income. Really simple to find. All of these things you can get on Google for free.
For free. Every single one of them. So the rule with that one is the higher the income relative to house prices, the better. Because people earning more money if they own the house, reinvest that money in renovations, knock down rebuilds, and
paying off debt.
So, you know, on the flip side, if, you know, people are earning good money in a suburb, like there's suburbs in Brisbane, right, where people earn 100, 150K per year and the weekly rent's only $500.
Yeah.
It's like when there's so much extra money left over at the end of the week in the suburb, rents can go up dramatically that way as well, which I love. So, you know, effectively the higher the better is the rule. But, you know, I've also bought suburbs where the average income was $400 a week on the central coast of Sydney, and that suburb still doubled between 2011 and 2015. So these aren't silver bullets, and one thing is important. It's just the overall context of the cycle.
Exactly. Now, the next is percentage of owner occupiers compared to renters. So this is a really good one. You don't want to be in an area where there's, flooded with renters throughout the area, because this is going to bring down the demographics within the suburb. You want people that care about their homes and that look after their gardens and paint the outside of their property every now and again. Two of my properties.
You should start painting the outside of your property.
Yeah, I just about to say that. I've got flaking paint. They get knocked down soon enough, guys. So I really appreciate the tenants, but I paint the inside, not the outside. But the owner occupiers are going to put a little bit more care, put a little bit more love into their properties. So we generally say, as a rule of thumb, ideally you want about 30% renters to 70% owner occupiers. That's like a sweet spot. But give or take 5-10% isn't going to kill you.
Generally, if you're looking at the beaches of Melbourne, the beaches of Sydney and the beaches of Brisbane, because people know that the beaches increase at a faster rate than other areas long term, and that's where people want to live and rent, generally you'll find in those suburbs, sometimes 40, even 50% renters. But then you see some of the sweeter spots closer to the CBD that are really owner occupied, and it's like, cool, like I've got suburbs that I own personally with literally 7% renters through to 55% renters. And it's like, again, none of these things are an absolute truth, but Simon's 100% right. 20 to 30% owner occupiers, renters is the sweet spot for the average property, but don't let that deter you.
No.
Now, I'll happily buy a beachside suburb with 50% renters like Cronulla.
Yeah.
But then there's a suburb on the south side of Brisbane that's pretty rough, that has currently like 50% renters, and I wouldn't go near it at this stage. Maybe in
literally
10 or 15
like get a little
years.
bit too scared.
Yeah, like it's rough as hell, and it's like very high crime rates, and it's very, very ghetto still. And so it's like you've got to wait for the rents to increase to a point where a lot of the housing commission people and the renters can't stay, and that's going to take time to wash through like that. I always say that when the rents get to about $500 a week, it flushes a suburb clean, and a lot more owner occupiers start moving in.
Yeah, nice.
Now, some of the other things that we follow that aren't so much the data are more of the softer things. So school districts and the quality of those schools, which you can find online, public transport options like buses, trains, access to major airports and things like that for business people, as well as the infrastructure. So what's going on with universities, hospitals,
shopping centres,
how close are high quality jobs and high paying jobs to the area that you're living in, and what does the commute look like for these things. Now, we were talking off camera a second ago, you can absolutely and clearly see in Sydney, Melbourne and Brisbane, the cheapest suburbs that are closer to the city are the ones without the public transport options directly in them, either access the major arterial roads easily or to buses or trains that take you straight to the CBD. And so when you start to understand this thing, you can understand why this suburb might be worth 300K more. It's just because at the moment it's 15 minutes easier to get to the CBD, even though it's only a couple of Ks further away. And so it's like understanding these things is super important, especially the school district thing. All of the Asian and Indian investors that we work with each year are just obsessed with the higher quality school districts, and because of that, the catchment drives up the prices.
No doubt about it. And having that easier connectivity, easier, quicker routes to get to the CBD or get to these major business districts where people are working, that's going to make things a hell of a lot easier. And, that can also impact something that we talked about earlier. Sometimes an area may be further away from the city, but quicker to get to the city because of the public transport options or the access to major arterial roads. So, you've got to find your sweet spot there as well.
I've heard Catherine Cashmore do a lot of number crunching and Phil Anderson on this. So they reckon when the best place to buy an area that doesn't have infrastructure is when the infrastructure is proposed at 100% going ahead. And they reckon, as well as Michael Matusik, that a train station can uplift an area's property prices by at least 20%. on average before it even goes in. Most of the growth is on the way in. Catherine Cashmore has also said that lifestyle is becoming such an important driver of property prices now that there's suburbs in Melbourne that are 30 k's from the city that have really, really good arterial roads or transport options that are now worth significantly more than suburbs 15 k's because people want time back in their life now, especially after 2020, and they want quality of life and lifestyle. So the old closest to the city that's always worked wins isn't always going to be the case. It's actually going to be closest to the CBD in terms of commute time could end up doing it.
Yeah, and we saw this on the Redcliffe Peninsula in sort of 2015, 16, where they finally approved the new train station and started works on putting it in there. And what was it? It was about a 20% increase over a 3-year period.
Crazy, on top of what the market was already going to do. Now, I'm a huge fan of the show $1 Million Listing New York, like a huge fan.
Ben loves selling sunsets, $1 Million Listing, he loves it.
I like the buyer's agents, I like seeing the deals. And so one of the things that I noticed when I'm watching it as like someone who's obsessed with learning more is when they're talking about New York, and if you're talking about a suburb without a subway, you're looking at millions of dollars difference between this suburb with one and this suburb without one. And I think that's a perfect example of a market on steroids that is the current reflection of every suburb in Australia. Like, I remember where we grew up in Sydney was really, really affordable, but it's actually got some of the best infrastructure and transport options on a train in Sydney, and over time, the market viewed that properly. And where suburbs with train stations in Sydney 20 years ago were the cheaper ones, they're now the most expensive because no one wants to get on the road anymore.
No, exactly. And as property prices become more expensive in Sydney, people need to look further away from the city to get into affordable housing options. Plus, they need the easy commute time. So it's a combination of all of these factors that need to be taken into consideration. But one of the last things that we wanted to talk about was the lifestyle. And I think this is becoming increasingly important because what 2020 did is it forced most people to work from home. So think about people yourself, if you're living in Sydney or Melbourne or Brisbane, where you would normally commute 30 minutes to an hour and a half to get to work each way. That's 30 minutes to 3 hours a day of commute times, and then you finally got that time back. And people were like, oh my God, I've got all of this spare time.
I can train, I can chill with my kids, I can see friends, I can meditate, I can sleep,
I can go out for brekkie,
do
whatever.
life admin. Massive.
So these lifestyle factors are becoming increasingly important. So, identifying areas and suburbs that have nice nature walks or, hills to go to, or a dam or a river nearby, or, a beach, obviously in an ideal world. Well, I guess we're biased because we love the ocean so much.
I mean, not everyone's a beach person, but, there's a lot of value on the beaches because they're not making any more land out there.
Exactly. And looking at the cafe culture, the restaurant culture, nice places for people to go out and about and socialize and things like this. And then walk score as well, which is something that you can find online, which is, how easy is it to get around the suburb?
Without a car. It's kind of like Michael Matusik said about 3 or 4 years ago that the number one thing that will drive high property prices in the future in certain locations in Australia will be lifestyle. Now, if you look at Casuarina, Kingscliff, Tweed, Byron Bay in northern New South Wales, if you look at the Gold Coast, if you look at the beachside suburbs of Sydney, Brisbane, Melbourne, the Mornington Peninsula, Geelong, you look at the Central Coast or Wollongong of Sydney, you look at the Sunshine Coast north of Brisbane, these are lifestyle orientated destinations because of all of the things that Simon just mentioned, and that is where the population, jobs, incomes and property prices have gone up or are about to go absolutely through the roof. It's insane at the moment.
The consistency is sort of what we're looking for. We're not trying to speculate. What we're trying to do, once again, have a long-term plan and get the best ROI over that longer term. So I guess you'd like to talk about a few examples as well of how we've used this for our own portfolios and when it's been successful.
There's this thing that Simon was talking about in planning for this podcast today, and that was like this concept of the domino or the ripple effect. I want to give you some examples of these, because this is the beautiful thing about property, right? It is so sentiment driven. If somewhere's hot, like this suburb's a flavour of the month, the money pulls in and people forget about the suburb directly next to it that could be half the price. So here's an example in Brisbane, which we know well. There's a suburb called Manly on the beach where a beautiful home could sell for $3 million. A average home could sell for $1 million, and a real shitbox might sell for $800K now. Now that suburb's 17 Ks from the CBD on the beach. If you were to go up to somewhere like Margate or Clontarf, which is 24 to 26 Ks from the city, so not much further, arguably with better infrastructure and a better lifestyle long term.
Nicer beaches. You
could get a really, really, really beautiful home for like 700, 800K, and you could get like a knockdown for like 450 grand right now. Like the price difference is almost between one suburb at 17 and one suburb at 24 Ks, you know, $500,000 to $1 million, depending on what you're looking at. And that is almost everywhere in Brisbane. There's another area closer to the city called Kedron that is super expensive, like $1 million, even up to $1.3 million for a nice place. 2 suburbs across, there's a suburb called Arana Hills, which isn't that much further as the crow flies from the city. And the property prices there might be still 600K. Like it doesn't make any sense. And it was the same in Sydney and Melbourne 20 years ago. But over time, that rising tide lifted all the boats.
Exactly. So understanding that ripple effect is great. I love it. You know, I've done it for every single one of my purchases, just purchase slightly further away from what's taking off at that point in time. And it's proven to be really, really, really powerful for myself.
For sure. So we hope you've enjoyed some of these things. Like we talked about the distance to the CBD, DSR scores and vacancy rates, average incomes and the percentages of owner-occupiers, as well as schools, public transport, infrastructure and lifestyle being the key drivers of a suburb. And I think the numbers are important, but intuition's equally important. And so driving around as someone who earns okay money and going, would I live here? Would I raise my family here? Or can I see future potential in 15 years in this area is equally important, and something that we do as well. Like it's awesome to have all the 1 or 0 rules in our business to buy, but a lot of it also comes down to like knowing what's happened in Sydney, Melbourne's, your Londons and New York's, and then taking that as an example to your Brisbane's, your Perth's, your Adelaide's as you start buying these areas in the next 5 years.
Yeah, history does have a funny way of repeating itself in a different way, and that's how we can see it. We view it as hindsight in a way, looking at these areas and then overlaying that to the demographics within the area. So, you know, property investing can be tricky. It can be super, super hard when you're looking at everything and then understanding these different ways to narrow down that big list of suburbs that you're looking at into a smaller list of suburbs and becoming really specific and really honing in and focusing on a singular area, because you're going to get a far, far, far better result if you can do that.
I think that's really important to wrap up the podcast. Like when I first started, I was looking at everywhere. I was looking at 2 capital cities. I was looking at 3 regional markets. I was looking at 20 suburbs at a time. And because of that, I made some major mistakes strategically because I just didn't know enough about an area to do what I needed to do. Now, 10 years down the track, probably the last 3 to 4 years in particular, I don't look, even as an investor, I don't look at more than 1 suburb personally at a time. When I go, I'm going to buy this suburb in this pocket, in these streets with this criteria, and we'll get into that criteria of the house in the next episode. But it is absolute laser focus, because to do something really, really well, you know, you don't see a professional athlete playing 3 sports professionally, even though a lot of these guys could have. They have to at some point focus. And for you to become the best version of yourself as an investor, you have to let go of all of the noise, do some strategic research like Simon said, choose your state, choose your city, choose your pocket of the city, choose your handful of suburbs to look at, and then just go absolutely hard at one of those suburbs. Even though it will take longer to buy that way, you'll be much more confident and sleep better with the decision that you've made. And, you know, the big lesson that I've learned is sometimes slowing down is so much better as an investor rather than just rushing out and grabbing stuff and then ending up like I did with a whole bunch of stuff that doesn't really make sense for the type of lifestyle I wanted to lead.
It's like what you've got on your vision board at the moment, which is the Bruce Lee quote, which is, you know, it's about the daily decrease, not the daily increase, taking things out. And that's really what we do a lot. It's more about what not to buy than it is what to buy, and taking out a hell of a lot of things, because then you mitigate your risk a little bit, and then you end up getting yourself a far better result. So, you know, I hope you guys have enjoyed the podcast today. I hope you got a little bit of value out of this one. And, you know, now if you're out there, you've defined your market, this may make it a little bit easier for you to go and figure out which suburb is going to be the right one for you to invest in.
We wish you all the best. Enjoy this market. It's going to be a fun couple of years. There's definitely some money to be made according to CBA, and we wish you all the best, and we hope that you don't just rush into it and get something, but you get something that in 15 years is going to make you better off with the compound growth we talked about at the start. Cheers, guys.
Thank you.
Oh, sweaty. So sweaty.